Have you ever wondered if there's a way to supercharge your portfolio's growth while still managing risk? What if I told you that small-cap ETFs might hold the key to unlocking huge returns, even in today's uncertain market? Let's dive into 4 secret ETFs that could be your portfolio's next big win before 2025. Today we're exploring the world of small-cap ETFs, funds that often fly under the radar but have the potential to deliver outsized gains. In fact, with the current market landscape showing signs of a shift, this might be the perfect time to add small-cap exposure to your portfolio. Whether you're looking for growth, diversification, or just a smarter way to invest, these ETFs can help you do it all. I'll break down 4 ETFs that can bring balance to your portfolio, with a mix of high growth potential and value plays. And I'll show you exactly how they stack up against their larger cap counterparts, so you can make informed decisions for your financial future. Ready to find out which ETFs could give your portfolio the boost it needs? Before we dive in, hit subscribe and smash that like button if you're ready to discover small-cap ETFs that could boost your portfolio. Why small-cap ETFs? So why exactly should you consider adding small-cap ETFs to your portfolio? It all boils down to one key factor: growth potential. Small-cap companies are often in their early stages of expansion, which means they have much more room to grow compared to their large-cap counterparts. Historically, small-cap stocks have outperformed large-cap stocks over the long term, especially during economic recoveries and market upswings. In fact, during certain bull markets, small caps have shown returns as much as 20 to 30% higher than large caps. But with higher potential returns comes higher volatility. Small cap stocks can be more sensitive to market fluctuations, but that's where ETFs come in. By investing in a small cap ETF, you're spreading your risk across hundreds or even thousands of smaller companies, which helps to reduce individual stock risk while still capturing the sector's growth potential. Instead of betting on 1 or 2 companies to hit it big, you're giving yourself exposure to a diverse range of future success stories. And the timing couldn't be better. With current market conditions showing signs of volatility, small-cap ETFs offer a unique opportunity to diversify your portfolio, especially if you're looking to balance your large-cap holdings with more growth-focused investments. We're seeing a shift where smaller companies are starting to gain traction, as investors look beyond the tech giants and other large-cap staples. In this video, I'll reveal 4 small-cap ETFs that not only have a track record of strong performance, but are also well-positioned for future growth in 2025 and beyond. Whether you're a seasoned investor or just starting out, these ETFs could be the secret weapon your portfolio needs to navigate the ever-changing market landscape. First up on the list is a fan favorite: the Schwab US Small-Cap ETF, or SCHA. This ETF gives you broad exposure to the small-cap space with an incredibly low expense ratio of just 0.04%. That's practically a steal compared to most other funds in the market. And with total net assets of $18 billion, SCHA is one of the largest small-cap ETFs out there, giving it stability and liquidity that many smaller funds simply can't match. Currently trading at around $26 per share, SCHA offers a dividend yield of 2.66%. Paying an annual dividend of $0.70. That dividend might not seem huge compared to some larger dividend-focused ETFs, but remember, this is a small-cap fund, so you're here for the growth potential. And SCHA has delivered on that front. It's up 10% year-to-date and has posted an impressive 34% return over the past year. Not only that, but over the past 5 years, it's achieved a 45% return, showing that this fund is capable of delivering solid long-term performance. Now let's talk about its holdings. SCHA includes a whopping 1,748 different companies, which means you're getting a broad swath of small-cap exposure across multiple sectors. Its top sectors are industrials, 15.99%, financial services, 15.94%, and technology, 15.49%. This gives you a balanced mix of sectors that are primed for growth, but it's worth noting that it also holds significant allocations in healthcare, 14.23%, and consumer cyclical, 12.93%. making it well-rounded for various market conditions. Some of the top individual holdings in SCHA include Vaxcyte, Incure 0.34%, Duolingo, Incure 0.28%, and BWX Technologies, Inc. 0.26%. Names that might not be household favorites yet, but that's exactly the point of small-cap investing. You're getting in on companies that have significant room to grow before they hit the big leagues. What really makes SCHA stand out, though, is its diversification, with companies across sectors like real estate, 7.48%, basic materials, 4.64%, and energy, 4.40%. This ETF is designed to capture growth in multiple industries, reducing your risk while still keeping you exposed to some of the most promising small companies in the U.S. And here's where SCHA really shines. By holding a wide variety of companies, it spreads out risk while still giving you access to some massive potential winners. Instead of picking one or two small caps and hoping for the best, SCHA gives you a basket of nearly 1,800 companies, meaning there's a much higher chance you're holding tomorrow's big success stories without putting all your eggs in one basket. If you're looking for broad, diversified exposure to small-cap growth with a rock-bottom expense ratio, Schwab US Small-Cap ETF is definitely worth considering as part of your portfolio. Next, let's take a look at the iShares MSCI Emerging Markets Small-Cap ETF, EEMS, a fund that offers a unique opportunity to diversify your portfolio by tapping into the potential of small-cap companies in emerging markets. While many investors focus on US or developed markets, emerging markets like Brazil, India, Taiwan, and Mexico are still in growth mode, and that's where small caps can really shine. EEMS has $386.22 million in net assets and trades at around $62 per share. One thing to keep in mind here is its slightly higher expense ratio of 0.70%, but that's not uncommon for international funds, especially those targeting small-cap companies in developing economies. The trade-off? You're getting exposure to some of the fastest-growing regions in the world. And with year-to-date returns of 9% and a 19% gain over the past year, EEMS is proving that it can deliver solid performance even in a volatile global market. In terms of sector diversification, EEMS is quite broad. Finance takes the lead with 16.54% of the fund, followed by electronic technology, 13%, producer manufacturing, 11.03%, and process industries, 8.23%. But what's really interesting about this ETF is its exposure to sectors like health technology, 7.11%, and technology services, 4.93%, which are vital areas of growth in emerging markets. These industries are fueling innovation and development in regions that are just starting to industrialize, meaning there's a lot of untapped potential. And while it's important to note that the dividend yield is relatively modest at 0.81%, giving an annual dividend of $0.51, you're not investing in this ETF for income. You're here for growth. Over the past 5 years, EEMS has delivered a return of 43%, and given the rapid urbanization and industrialization taking place in many of these emerging economies, there's significant room for future growth. The fund's top holdings also reflect its focus on innovation and financial stability. For instance, XTSLA, 1.51%, International Game System Kuikakrisi, LITI, 0.60%, and Coforge Limited, 0.36%, are key players in their respective industries. These are not companies most investors in the U.S. might be familiar with, but they are household names in their home markets, and they're poised to grow as their economies expand. One of the biggest advantages of EEMS is the exposure it offers to regions and sectors that aren't typically part of most investors' portfolios. With holdings in areas like retail trade, 3.77%, non-energy minerals, 4.53%, and consumer durables, 3.34%. You're getting in on the ground floor of sectors that are critical to the development of emerging economies. If you're looking to diversify not just by company size but by geography, EEMS is a strong choice. This ETF gives you access to the growth potential of small-cap companies in some of the fastest-growing parts of the world, making it a perfect complement to a U.S.-heavy portfolio. Next up is the Pacer US Small-Cap Cash Cows 100 ETF, or CALF, which is an exciting option if you're looking for small-cap companies that are cash flow machines. CALF focuses on companies that generate high free cash flow, meaning these businesses have more money than they need for daily operations, allowing them to reinvest in growth, pay dividends, or even buy back shares. CALF has a total of $9.2 billion in net assets and trades around $46 per share. While its expense ratio of 0.59% is slightly higher than some other small-cap ETFs, you're getting a specialized product here, one that targets companies with strong financials and high cash flow, which can be a great defense during market downturns. In terms of returns, CALF has been down 4% year-to-date, but don't let that fool you. It's still up 17% over the past year and has delivered a remarkable 78% return over the past 5 years. This shows that despite short-term volatility, CALF has a solid long-term track record. If you're in it for the long haul, this ETF has a history of bouncing back and delivering strong returns. What makes CALF really interesting is its sector composition. The ETF leans heavily into consumer discretionary, 29.07%, industrials, 23.55%, and energy, 14.02%. Sectors that are ripe for growth in an economic recovery. Consumer discretionary companies, for instance, tend to perform well when consumer spending picks up, and with industrials and energy also in the mix, you're looking at sectors with big upside potential, especially if we see more economic momentum in the near future. The fund's top 10 holdings make up about 21.26% of the total assets, giving you significant exposure to some interesting small-cap players. These include Muller Industries, Inc. 2.38%, Consol Energy, 2.34%, and Insight Enterprises, Inc., 2.32%. Companies like Signet Jewelers, 2.07%, and American Eagle Outfitters, 2.04%, are also in the top 10, showing that CALF is betting on some well-known consumer brands to drive future growth. With 102 total holdings, CALF gives you concentrated exposure to small-cap companies that are flush with cash, meaning they have the resources to grow and weather tough market conditions. That's particularly important in today's environment, where many smaller companies are struggling with high inflation and supply chain disruptions. CALF's focus on financially healthy companies puts you in a good position to capture growth, and while the dividend yield of 1.26% and an annual dividend of $0.58 might not be the primary reason to invest in CALF, it's a nice bonus on top of the potential capital appreciation you could see from its holdings. If you're looking for a small-cap ETF that focuses on companies with strong cash flow and financial stability, CALF is a great option to consider. It's perfect for investors who want small-cap exposure, but with a little more financial cushion to ride out market volatility. Last, but certainly not least, we have the Vanguard Small Cap Value Index Fund, VBR, a great pick for investors who are looking to combine the growth potential of small-cap stocks with the stability of value investing. VBR focuses on small-cap companies that are currently undervalued, offering a solid mix of growth potential and reduced risk compared to higher growth, more volatile small-cap ETFs. With total net assets of $30.785 billion, VBR is one of the largest small-cap value ETFs out there. It's trading at around $201 per share, which may seem steep, but given its expense ratio of just 0.07%, you're getting tremendous value for your investment. This low expense ratio means more of your money stays in the fund, working for you, something Vanguard is known for across its ETF lineup. Now let's talk performance. VBR is up 12% year-to-date and has delivered an impressive 33% return over the past year. Even better, over the past 5 years, it has gained 54%, which is a solid performance for a value-focused ETF. Value stocks tend to outperform in times of market uncertainty or when the economy is recovering, and VBR offers the perfect way to tap into that trend. One thing to love about VBR is its dividend yield of 1.7%, paying an annual dividend of $3.48. While you're here for the potential appreciation of undervalued small-cap stocks, that dividend is a nice bonus, offering income as well as growth. And as a value ETF, VBR tends to be more stable during market downturns, which can help balance out the volatility of other growth-oriented funds. The fund holds a well-diversified portfolio of nearly 1,000 securities, which reduces your exposure to any one company while giving you broad access to the small-cap value space. Financials, 20.11%. Industrials, 19.84%. And consumer cyclical, 14.05%. Make up the largest portions of the fund, with sectors like real estate, 10.12%, technology, 7.84%, and healthcare, 6.79%, rounding out the mix. This broad sector diversification means you're capturing value in some of the strongest sectors of the economy, providing balance and reducing risk. The top 10 holdings in VBR include companies like Smurfit Westrock plc, 0.73%, First Citizens Bancshares, Inc., 0.65%, and Builders FirstSource, Inc., 0.63%. These aren't necessarily household names, but they represent strong, financially sound companies that are trading below their intrinsic value, perfect targets for value investors looking for long-term growth. What makes VBR stand out is its commitment to value investing. Even in the small-cap space, you're not just getting small-cap growth potential, you're getting companies that are undervalued and have room to grow, which means less volatility and potentially higher returns as these stocks reach their full value. If you're looking for an ETF that can provide both growth and stability while tapping into the small-cap value space, VBR is a fantastic option. It's a great addition to any portfolio, especially if you want to balance out higher-risk growth investments. Now that we've covered 4 incredible small-cap ETFs that can boost your portfolio before 2025, I want to hear from you. Which one of these ETFs are you most excited about? Do you already hold any of them in your portfolio, or are you thinking about adding one after today's video? Let me know in the comments below. I'm always interested in hearing how others are navigating the market. And don't forget, if you found value in today's breakdown, make sure to hit the like button and subscribe to the channel. I've got plenty more ETF insights and investment strategies coming your way, so you won't want to miss those.